Change in the cost of production. The cost of production includes expenses related to raw materials, wages, machinery, energy, and other inputs. When these costs increase, firms may reduce production to maintain profit margins, leading to a decrease in supply. For example, if the price of crude oil rises, gasoline production costs also increase, leading to a reduction in supply. Conversely, if input costs fall due to factors such as improved efficiency or lower material costs, firms can produce more at the same price, leading to an increase in supply. Change in the number of firms in the industry. The total market supply depends on the number of producers operating in the industry. If more firms enter the market, supply increases because there are more producers contributing to total output. On the other hand, if firms exit the industry due to low profitability, regulatory challenges, or competition, supply decreases. For example, the rise of multiple smartphone manufacturers has led to an increase in the supply of smartphones worldwide. Change in the level of demand for the commodity or market size. An increase in consumer demand signals producers to ramp up production to meet market needs, resulting in increased supply. If demand falls, firms may reduce production to avoid excess stock, leading to a decline in supply. For example, if consumer demand for electric vehicles rises, car manufacturers invest in EV production, increasing supply. Change in the level of technology used in the production of the commodity. Advancements in technology can improve production efficiency, reduce waste, and increase output. Automation, artificial intelligence, and better machinery help businesses lower production costs and increase supply. For example, in agriculture, the introduction of genetically modified crops and irrigation technology has significantly increased crop yields, boosting supply. Change in the objective of the firm. Businesses may have different objectives such as profit maximization, market expansion, sustainability, or cost reduction. If a firm shifts its focus from short-term profits to long-term growth, it may increase supply to capture a larger market share. Conversely, if a firm shifts towards premium or niche products, it may reduce supply in favor of higher-margin goods. For example, some automobile companies have reduced production of gasoline-powered cars to focus on producing electric vehicles. Change in the gestation period of the commodity. Some goods take longer to produce due to lengthy production cycles, affecting how quickly supply can respond to demand changes. Perishable goods such as vegetables have a short gestation period, allowing farmers to adjust supply quickly. However, industries like construction and aircraft manufacturing have long gestation periods, making supply adjustments slow. Change in the level of supply of factor inputs, availability of factors of production. Factors of production, land, labor, capital, and entrepreneurship determine a firm's ability to produce goods and services. If land, skilled labor, or capital becomes scarce or expensive, production slows down, reducing supply. For example, a shortage of semiconductor chips has caused disruptions in the supply of cars and electronic gadgets. Some goods are produced together as byproducts or co-products. For example, crude oil refining produces both gasoline and diesel. If gasoline prices rise, more crude oil will be refined, leading to an increase in diesel supply as well. Conversely, if the price of one jointly supplied good falls, production of both may decline. Change in the price of a competitively supplied product. If two goods compete for the same production resources, a change in the price of one can affect the supply of the other. For example, farmers who grow both wheat and corn may switch to corn if corn prices rise, reducing the supply of wheat. Change in the political climate in the area. Political stability attracts investment, encourages business expansion, and leads to an increase in supply. However, political instability, such as wars, conflicts, or government policy uncertainty, disrupts production and decreases supply. For example, civil unrest in a country may halt factory operations, leading to a shortage of goods in the market. Change in natural factors or climatic conditions. Climate and natural events impact industries such as agriculture, fishing, and mining. Favorable weather conditions result in abundant harvests, increasing supply, while droughts, floods, and hurricanes can reduce supply. For example, poor monsoon rains in India can lead to a decline in the supply of rice, affecting global markets. Change in the level of development of infrastructure. Efficient infrastructure like transportation, electricity, and communication lowers production and distribution costs, increasing supply. Poor infrastructure hinders production and transportation, reducing supply. For example, countries with well-developed ports and highways can distribute goods more efficiently, increasing market supply. Change in the degree of freedom of entry of firms into the industry. If new firms can enter the market easily, supply increases due to competition. However, if barriers such as high startup costs, licensing restrictions, or monopolies exist, fewer firms enter, keeping supply limited. For example, the deregulation of the airline industry in many countries has led to increased supply as more airlines entered the market. Changing government policy of taxation and subsidization. Higher taxes increase production costs, discouraging supply, while tax cuts encourage production. Subsidies lower production costs and increase supply by making production more profitable. For example, government subsidies on solar panels have led to increased production and supply of solar energy products. Change in working conditions. Good working conditions, fair wages, and worker incentives improve productivity, leading to an increase in supply. Poor working conditions, labor strikes, and unsafe environments reduce productivity and disrupt supply. For example, strikes by auto workers in major car manufacturing hubs have led to supply shortages. Expectation of future price changes. If producers expect prices to rise, they may hoard products or delay production, reducing current supply. If they expect prices to fall, they may release more goods into the market before prices drop, increasing current supply. For example, if oil producers anticipate higher future prices, they may reduce current output to sell at a better price later.